Welcome to Chapter 4, Mutual Funds. This is a very important chapter for you, dear students. Why? Because chances are very good that you will be confronted with a 401k type plan at your business of employment, or maybe a 403b if you work for a nonprofit. And most likely the investment choices will be mutual funds. So apart from understanding the basic concept of investments and that we discussed in Chapter 1 and the risk versus return, you really need to understand mutual funds. So let's get started. I've included a comment, a adage, a label that some people use. You won't hear it too often, but I like to use it. Mutual funds are investments for the masses. Why? Because most people aren't going to sit down and take the time necessary to learn about what the difference is between all the different types of investments that they can do out there. They might be goaded into buying some penny stock by their brother-in-law who thinks he knows what he's talking about, but eventually they're going to stop that because they're going to get burnt. No, mutual funds do the hard work for you. Now, does that mean that they do necessarily a good job? Some yes, some no. Slide number 2. What is a mutual fund? Well, I like to use the legal term. The legal term is the investment company. But you won't hear that too often. You're going to mostly hear mutual fund. But that's what a mutual fund is. It's an investment company that invests its shareholders' money in a diversified portfolio of securities. In other words, they pool your money together and they go out and buy the stocks, the bonds, or whatever the underlying investment is. As we said, investment company is the legal term, but you won't hear that unless you work in the industry. You will hear mutual funds. And the two major advantages of mutual funds are professional money management and diversification. So I want you to memorize those. We're going to come back to those over and over and over again. Each fund has a specific objective, and there are over 11,000 funds to choose from. Wait a minute. Are there 11,000 different types of breakfast cereal in the grocery store aisles? Oh, sometimes it seems that way, right? But no. 11,000 different types of cars? Or, no, it just doesn't. What happened in the mutual fund industry? Well, there's several reasons, which we will discuss as we go along. Competition, and the fact that these things are extremely profitable has helped grow the industry to the point where it's impossible to get your arms around it. And that's one of the things we're going to be dealing with over the next 4 presentations. Many people choose mutual funds for their retirement accounts. They're not perfect, folks. 401ks, 403bs. But they're what's happening. And that's part of your assignment, is to take a look at a 401k plan, specifically the thrift savings plan, which is the federal employees' 401k. Where do these names come from? They come from the Internal Revenue Code, 401k, 403b. And we'll discuss those later. We discussed them in detail in the BUS123 class. IRAs, individual retirement accounts, traditional and the Roth IRA, they're very popular with mutual funds also. So here is my graph, and this graphic from slide number 3, and this should look familiar. I know I'm not the best drawing person. I'm not very artistic. My brother got those genes. Here we are, folks. We're the little people. And there are millions of us little people, and more of them are women because they're realizing that don't leave it to the guys, folks, gals, because they mess up things pretty badly. Especially the young the women, they're realizing that, Grandma got royally screwed because Grandpa said, or great grandpa said, "Don't worry, little lady, I'll take care of the finances." And he did a horrible job, and then he died, leaving her penniless. And the younger women are saying, "Not me, no way." And we little people, through our regular accounts or retirement accounts, give our money, send our money every month, $50, $100 if we can afford it, to the mutual fund managers. And these are the people with the top hats. That's like, they're the people on Wall Street with the top hats. I know. And look, more and more of them are women. Those are women. And it turns out, it's already been statistically shown that women are better investors than men. I'll leave it to you to decide what the reasons are. I have my own opinions, but be that as it may, the statistics tell us that women make better investors. And what these people in the top hats do is they create a pool of money. Now, I know it looks kind of like a potato, but it's supposed to be a pool of money. And because there are millions of these people giving $50, $100, we're talking about billions of dollars, in fact, trillions of dollars. And then the mutual fund managers, they go out and they make the decisions about what stocks to buy. That's a stock mutual fund. They make decisions about which bonds to buy. That's a bond mutual fund. If they buy the short-term cash instruments that we discussed in Chapter 1, that's called a money market mutual fund. But what you find is people don't call it a money market mutual fund. They just call it a money market. We start to see the beginning of the huge explosion of different types of funds when we see that there are balanced funds that invest in both stocks and bonds. And why do we like mutual funds? Professional money management. The people in the top hats get paid very well. Some are very good, some not so good. And we get instant diversification because they don't buy 5 stocks or 5 bonds. They buy 150 or 300. And so if one company or one bond goes bad, exactly, you're held up by the fact that you have diversified across hundreds of individual securities. Slide number 4. Look at the growth of the industry. Now, I get this data from the Investment Company Institute, which is the trade group. It's a nonprofit trade group, but it's very potent, folks. They have a lot of economists on their staff. And every year around May, they come out with the new statistics for the previous year. And it's a sip from the fire hose. I mean, they really do pack in a lot of data in that annual fact book. 1940 is often used as the year that mutual funds coalesced into an industry. Now, there were mutual funds before that. There were specifically 70 of them that had been around for upwards of 15, 16 years, some of them. The oldest one, I think, is 1924. But that was the year the Investment Company Act of 1940 was created, which was a landmark piece of legislation which shows you that the folks in Washington can play nicely with one another when they put their minds to it, and has served the industry well these many years. 30 years later, we're looking at 350 in 1970. In 1980, there were 600. And then the explosion in the markets began. Between 1980 and 1990, there were 2,000 funds, tripling the size, and then quadrupling in half the size between 1990 and 2000. Yeah, that was the go-go internet, the technology, Y2K, blue skies, productivity gains. Yeah, the industry has been tempered. And as of the end of 2015, according to the Investment Company Institute, there were 11,672, which includes all open-end funds, all closed-end funds, and ETFs, exchange traded funds. And we will discuss each of these three different types of funds in detail. So it's a big industry, folks. Slide 5. In 1980, 5 million Americans owned funds holding about 3% of their household financial assets. As of December 2015, 93 million Americans in 54.9 million households, which is almost half, 44%, totaling $18 trillion. Indeed. And that's 22% of household financial assets. Mutual funds are now the nation's largest financial intermediary, which is a fancy way of saying they hold other people's money, followed by the commercial banks and the life insurance companies, often called the invisible bankers. So this is a very important, large industry. Is it perfect? No. I mean, there are warts along the way, and we'll do our best to point those out. But all in all, it's a pretty darn good deal, folks, for the vast majority of people who have no interest whatsoever in taking BUS123, Introduction to Investments, and learning about all the things you need to know before you make a choice of a stock or a bond or other financial asset. And so, it works. It ain't perfect. There are problems that we'll see, but it works, and it's been very successful. Slide 6. Look at the assets over the last 10 years. In 2007, the industry had hit $13 trillion. And then 2008 came along. Bang, right? It was a very difficult year. And considering that there's about $3 trillion at any one time in money markets, which don't lose money, that was a big drop. But we've come back to the point now where at the end of 2015, we were looking at $18 trillion. Pretty amazing. Pretty amazing. The industry has done very well for itself. And so we have to do our best to hope that it continues and work to make sure it continues to do well for people. Slide number 7. As we said, what are the advantages of mutual funds? We said that they have two major advantages. Diversification. Pooling our investments together gives investors the ability to buy a diversified portfolio of securities for the collective benefit of all the individual investors. This variety provides some safety that is difficult for an individual investor to obtain on their own. In other words, folks, it's difficult to know what's going on with more than 10, 20 stocks, any individual person. And if one company does poorly, well, then, it's going to really affect your portfolio. But if one company goes Enron or Kodak and disappears, then, it doesn't hurt the portfolio as much as it would if you only had 10 stocks. And these people are paid well, folks, and they are the cream of the crop. I mean, some of them are very, very high-powered. And they're supposed to know what they're doing. They're getting paid pretty well, and some of them, as we said, are pretty darn good, and others are just not so good. And this just makes perfect sense. Do you go out and build your own car in your backyard? I mean, some people do, some people, not many. Do you make your own shoes? Yeah, it just makes sense. The problem is that it's the investment world. And there's an art as well as a science to it. And so it's not as easy as going out and looking at the reliability statistics of a certain brand of car and how much it's going to cost you over the it's a very different world. There's a lot of emotions involved, as we've seen and we'll see as we continue. Those are the two main reasons, and those are the ones I want you to remember. And if somebody asks you, well, because remember, you're the expert now in your family and friends, why do you invest in a mutual fund? Well, we get instant diversification, and professional money management. But there are a couple others that you can mention. You don't have to, but the initial outlay of capital, meaning how much money you got to come up with, is very small. Most all mutual funds, providing you sign up for automatic contributions electronically through your paycheck or through your checking account, will let you start with $25 or $50 a month. Now, they don't want you to send in a check for $25 every month, folks. It costs them $5-10 just to process the check. But it doesn't cost them a dime. Maybe it costs, fractions of a penny for them to set up an automatic contribution and have that done, every month. And so, yeah. And the PETA factor. I love this. This is The Wealthy Barber, and he's a great guy. I really enjoy reading his book, and I hope you read it someday, too. It's out of date. He hasn't really done a good job of keeping it up to date. It's written in the later 1980s, but the concepts are timeless. So the numbers are wrong. Oh, well. He calls it the PETA factor. Pain in the... Right. Yeah, they're easy, folks. Once you've made your decision about mutual funds, and that's a difficult process, but once you've done that, there's nothing else for you to do. I mean, you keep track of them every 6 months, a year or so, but for the most part, if you've made a good decision on a company that's been around for decades and has done well in good times and bad, and we'll discuss that as we go along, then there's not a whole lot you can do. And I have a renewed appreciation for my mutual funds after having gotten involved in investing in the real estate world, folks, where the PETA factor is through the roof. See, I gotta keep my blood pressure down. Okay. Slide number 8. What are the drawbacks? Well, nothing's perfect, right? Nothing's perfect. I hope you will see by the end of this semester, every investment has advantages, every investment has disadvantages. And the major disadvantages of mutual funds is that they are not free. Well, you wouldn't think they would be, but many people really do not understand how they're being charged with their mutual funds, which is a problem. They have this feeling they know they're being charged somehow, but they don't understand it. Excuse me. And you, dear students, by the end of next presentation, will understand it. You might not like it, but you'll understand it because I'm going to hammer it into your head. Some mutual funds charge a sales load, a front-end load, a back-end load, a contingent deferred sales charge. I love that word, contingent. And many others are no-load funds. But you have to be careful. Some no-load funds can wind up costing you more than load funds over time. Why? Because of the annual operating expenses. The annual operating expenses range from less than 0.5%, meaning 50 cents for every dollar, for every $100 you have in the account, upwards of 2% or more, $2 for every $100 you have in the account. And that's charged annually, folks. Why? Because it costs money to run the fund. And many mutual funds do not match the market's performance. What? Aren't the mutual fund managers supposed to know what they're doing? Well, as we'll see, it's not that easy. There are many subtle factors at work here. But it's true. Some mutual fund managers really stink up the joint. Oh well. Nothing's perfect. Slide number 9. Now, we want you to spend a little bit of time on the discussion between open-end and closed-end funds, and then we'll take a look at the hybrid exchange-traded funds. Open-ended funds are far more prevalent. They are the type of investment company in which investors buy shares from and sell them back to the mutual fund itself, with no limit on the number of shares the fund can issue. So we don't tend to worry or think about this. We just send them our money, and then when we want our money back, we asked it for it. But what they're doing is they're taking your money and they're creating new shares. Shares are issued when you buy the mutual fund, when you invest in the mutual fund, and shares are redeemed when you sell your mutual fund at the request of the investors. So investment companies, mutual funds, are essentially open-ended. There can be as many shares as you want, depending on how much you want to buy, or as you redeem the shares, they are taken out of circulation. Investors can buy shares from, purchase, and sell shares to, redeem the investment company at any time. When people refer to a mutual fund, they are almost exclusively referring to an open-end mutual fund. As of December 2015, the last information from the annual fact book from the ICA, there were 9,520 open-end mutual funds totaling $15.65 trillion in assets. Now, what's the other type traditionally? The other type were closed-end. And what's happening is we're seeing closed-end funds disappearing. The numbers of both the absolute number of funds and the amount of investments that they have under their tutelage, under their management, is shrinking. And I'm not sure exactly the reason for it. I think it's probably the growth of ETFs, which we'll take a look at in a minute. But closed-end funds were never really that popular to begin with. It's a type of investment company that operates with a fixed number of shares outstanding. Shares are issued by the investment company only when the fund is organized. So when the mutual fund is created, there are a set number of shares, and it doesn't change. Once those shares have been sold to the initial investors, you can only purchase the shares from another investor. This is how stocks and bonds work, folks. So they are bought and sold like stocks on the open market, and you go through a brokerage firm, so you incur the commissions. As we said, closed-end investment companies are not as popular with individual investors as open-end. At the end of 2015, there were only 558 of them, holding about $261 billion. I'm sorry, not trillion. So you see, they're far smaller. The number of these and the amount of money that they have under their management is far less. They're just not that popular. Net asset value, slide 11. What is the net asset value? NAV. You'll see that people just write NAV. That's the underlying value of one share in a particular mutual fund. At the end of every business day, the mutual funds are required to add up the value of the securities in the mutual fund and subtract any liabilities, meaning any bills they have to pay, and then divide by the number of shares. Open-end mutual funds are sold at net asset value with a sales charge added if it's a load fund. But closed-end mutual funds are bought and sold on the open market. And so their price will vary from the net asset value, reflecting either a premium above or a discount below the net asset value. It's usually at a discount. Anywhere, it's not much, for 25 cents or something like that. They are very rarely priced at their net asset value. So, this might sound a little technical, but it's really pretty darn easy. Here's the formula. Excuse me. On slide number 12, you take the value of the fund's portfolio, so at the end of every day, they got to go run around the world and find out how much how much these shares were selling for or the bonds were worth at the very end of the day. And then they subtract any liabilities, which we said are going to be small, bills they have to pay, or if they have to go out and buy some more shares or whatever, or pay people off. And you divide that by the number of shares outstanding. So here's a sample. You take the value of the fund's portfolio, let's say it's $10,050,000. And they owe somebody $50,000, or they have bills of $50,000. So that's $10 million. There's only 1 million shares. The net asset value would be $10. Now, do you ever have to do this calculation? No. It's always done for you, so I'm not going to ask you to do it or anything like that, but it's not that hard. And then, if there's a sales commission, say 5%, the offering price will be the $10 plus the 5%, in this case $10.50. So I think those are pretty straightforward, but again, you don't have to do them ever because they're always done for you. You just look up it on the internet, boom, it's there. All right, so let's take a look at the advantages and disadvantages of open-end versus closed-end. Well, open-end funds, you have no market forces. You don't have to worry about a premium or a discount. You always can buy from the company. You can always sell back to the company. Open ends are very popular. A wide range of choices. But here's a problem with open ends. Because they are open end, if they become very popular because, say, they did really well last year or last 5 years, investors can pile into the fund and start buying up more and more shares because there's no limit to the number of shares that can be created. And now all of a sudden your $1 billion fund is now $40 billion, and you have to go out and find more investments to invest in, right? So it can become difficult to manage the fund. When that happens, often what some companies will do is they will close the fund to new investors. They say, okay, we're big enough. We don't want to get any bigger. Our current investors can stay here and they can add more money, but no new investors. Other companies deal with it differently. They add more advisors. They scale the size of the mutual fund by simply making mutual funds inside the mutual funds, if that makes any sense. And if it doesn't, don't worry about it. You're not going to manage a mutual fund anytime soon. The same problem happens, but in reverse, if all of a sudden the mutual fund becomes unpopular. Investors can just run for the exits and sell all their shares, and now the mutual fund company has to deal with that because, they got to pay off the investors, and that means they might have to sell investments at the worst possible time. The market's down. So open-end funds, not for the investors, but for the managers of the fund, can be difficult to handle. That's not a problem with closed-end funds. The closed-end fund doesn't have to worry about large purchases or large redemptions. They have a set number of shares. So you see, that's one of the advantages that we don't hear much about because closed-end funds aren't that popular. Plus, you have to buy them through your broker, so there's a commission involved. And there's often a premium or a discount to the net asset value. And I ask, which one would you prefer or do you prefer? And obviously, many of you have never even purchased a mutual fund, so you don't know. Most likely, unless you are very savvy and get involved in individual securities, you're probably not going to buy a closed-end mutual funds. And that doesn't mean there aren't very good ones out there, folks. It just means that they're just not as popular. Slide number 14. Okay, and now for something completely different. Why? Because about 25 years or so ago, a new type of mutual fund, which is basically a hybrid of the two, it is an open-end fund, but trades on the exchanges like a closed-end mutual fund. So it's open-ended, so there's no limit to the number of shares, but you must purchase the fund using a brokerage account, which means you incur brokerage transaction fees. And we are discussing what are now called ETFs, exchange traded funds. They have become very popular, folks, for various reasons. One of the biggest reasons, as we'll see, is that their fees are very low. Indeed. But do you want to pay the brokerage fees? Well, not really. And so what some of the companies have done, very smart marketing, folks, they have created their own brokerage firms. And we'll talk about the two biggest companies, Fidelity and Vanguard. They have their own brokerage firms. They're not the same company. They're a sister company, but they have the same name, Fidelity Advisors or something like that. I'm not sure exactly the name, but it's the same company. This is a sister company. And you buy their ETFs through their brokerage firm, they waive the commission, which means they don't charge you commission. Very smart. Very, very smart. Yeah, so these guys are no dummies. And ETFs are becoming very popular. Let's take a look at slide 15 and the growth of the ETF industry. If we go back to 2006, we see that there were about 359 of these things, totaling 423 billion. And then 2008 comes along, but you see that the number of ETFs continued to grow. 629, 728, and it went down a little bit, they went down in value a little bit, but because of so much popularity, it only went down a lot less than what happened in the open-end world. And then the growth has been, pretty darn strong since then. And at the end of 2015, almost 1,600 of these things, totaling $2.1 trillion. And there are people who are saying that ETFs are going to replace all the open-end funds. I don't believe it. I mean, they're going to be popular. They already are, but there's room in the world for both of these things, especially when, as we will see, the truth comes out. That there are people who will tell you that, these things, nobody can beat, all the active managed funds can't beat the indices, and we're getting ahead of ourselves here, folks. But it's just not true. It's just they're talking about the average, and yes, on average, most people can't dunk a basketball, or hit a fastball at 95 miles an hour, or hit a little golf ball 400 yards down the fairway in 3 shots. But there are people who can do these things, and we'll discuss these in detail in our third presentation. Slide number 16. How are mutual funds regulated? Well, you would think, this is such a big industry, you would think there'd be plenty of regulations, and you'd be right. But the cool part about this is that it was all done back in 1940, and really has been tweaked along the way, certainly, but they said it, and they did such a great job. It defined a regulated investment company, which is a pass-through investment vehicle. They don't pay any taxes on the money you earn. That makes sense. But at the time, you got to believe that there were regulators and people in the banking industry and the government who were going, well, wait a minute, what do we do with these things? When you're a company and you make money, the IRS says, yeah, you owe us taxes. And the mutual fund companies, no, you don't understand. Whatever money we make on the running of the fund, yeah, we'll pay taxes on that. But we're not going to pay taxes on money that we didn't earn. We earned it on behalf of our investors. Go tax the investors. And the regulators were scratching their heads and said, okay, I guess that makes sense. But the Investment Company Act of 1940 put it in stone, was the foundation of the modern mutual fund industry. So this is a lesson in politics, folks. They can do it. When they put their minds to it, the demagogues and the Republicans can work together, yes. To qualify, an investment company must hold almost all of its assets as investments in stocks, bonds, other traditional securities. There's a very limited ability to use derivatives or other risky strategies. Now, there are tweaks that have been done to this where, mutual funds can adapt, but for the most part, no. They are your idea, your reason to live is to allow people exposure to the stock market or the bond market or the short-term securities market, the cash market. You're going to work on their behalf, so no hanky-panky. They must use no more than 5% of their assets when acquiring a particular security. Now, what does that mean? Well, if you divide 100% by 5%, you get 20. Right. They must have at least 20 individual securities. They can't buy all one company and say, okay, we've invested for you. They're enforcing diversification. Now, as we said, most companies have a whole lot more than 20. They have 200. But still, the law says they cannot have less than 20 when they start out. Right. And they have to create an organization with checks and balances. And if you've taken civics or political history, science, you know what that means. They're looking at each other's cookie jar. They're watching what's going on and making sure no hanky-panky happens. Slide number 17. Now, this is a a graph from your book, I would have turned it upside down. I would have put the shareholders at the bottom, but they put the shareholders at the top, whatever. The shareholders are represented by the board of directors. Now, the board of directors throughout the years have been accused, the boards of directors have been accused of being rubber stamp organizations that basically did whatever the company wanted them to do. And that's, there's some truth to some of those accusations in some instances, and others not so much. The board took their job seriously. They are essentially looking out for the shareholders' interest to make sure that the investment company does what it says it's going to do and has the best investment advisors and other people who manage the fund. And then they oversee the mutual fund. Now, I don't know what this is supposed to be, this little thing that says mutual fund, but the idea is the mutual fund is made up of several companies. The most important is the investment advisor, the management company, because these are the people in the top hats. These are the people who go out and knock on the doors of Ford and GM and Honda and Toyota and Chrysler and say, okay, what's going on? Should we invest in you? And they, as we said, are paid very well, and some do a very good job, and others, not so good. But they don't hold on to the fund assets. Oh, no. The custodian actually holds on to the fund's assets. Are you with me? You understand? The investment advisor makes the decisions, but they don't write the check. The custodian holds on to the shares and holds on to the money. Right. And then who sells the shares? Well, that's a distributor. And they often go directly to the public, or they go to brokerage firms and other financial institutions and sell to them, who then sell to individual investors. The transfer agent is the company that actually processes the buy and sell orders for investors. And then you have an independent public accountant, one of the big accounting firms, who certify the fund's reports and their transactions. So every year, I'm not sure exactly how often it happens, but I'm assuming it happens at least once a year. Probably it's an ongoing process. They're all out there checking to say, okay, you guys said you own 100 shares or 100,000 shares of Microsoft. Where are they? The custodian, here we have them. Here they are. Okay. Are you with me? So they're looking out over what's going on. And so slide numbers 18 and 19 simply are the reiteration of what we just described on slide 17. The mutual fund is the corporation run by the board of directors. They're voted in by the shareholders and sponsored the fund's creators. The investment advisors are the portfolio managers, the management teams, the research analysts who focus on a specific industry. The distributors distribute the shares to the public and to dealers. They are essentially running a continuous initial public offering. And you don't know what that means. Don't worry about it. We'll discuss those in Chapter 5, and we really won't discuss them that much in detail because it's not that important unless you're going to take the Series 7 and become a stockbroker. Then you really have to know them. But for the most people, most part, IPOs are not important to most investors. So that's what the distributors do. The custodian, as we said, is the company that actually holds the securities. It's a bank or a trust company often. And the transfer agent is the company that actually keeps track of the purchases and the redemptions. And the independent public accounting firm is the company that's overseeing the whole operation to make sure that all the transactions are legitimate. Why the large diversification of tasks and companies? Well, we've seen mutual funds are highly regulated in order to protect the shareholders' investments from fraud and collapse. And how often have you heard about a scandal at a mutual fund company? Until 2003, you never heard what? Piano? Did you just say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, as a matter of fact, yes, I do. Since 1940, the mutual fund industry has been regulated and escaped any hint of propriety. I mean, there were a couple of things on the way. Back in the early 70s, the guy who ran away with some of the money, it wasn't very much, it was like $4 million, and he ran to Cuba. He was actually an acquaintance of then President Richard Nixon. But no, it wasn't until 2003 that some practices that were not quite illegal, but obviously unethical, were uncovered. There were only a handful of funds and a handful of people who were involved in these things, and it tarnished the entire industry. It was a black eye, and most people in the industry were upset and abhorred by these actions. They were very upset because they really weren't doing things that were illegal, but they were not right. And you're probably thinking, well, what could they be doing, Payano? I'll try to explain. And if you don't understand, don't worry about it. But mutual funds in the United States are priced at 4 p.m. Eastern Standard Time, because that's when New York closes. Okay, but remember, the world is global, and there are mutual funds that are based all around the world. So say you have a Japan fund. All right, you have a Japan fund. Now, what's going on? The United States market tanks, drops 1 or 2%. You know that a few hours after 4 p.m. Eastern Standard Time in New York time, the Japanese market's going to open up. But you priced, or at least the mutual fund priced, those securities in Japan the previous day's close. They haven't changed, right? They won't change their prices until Japan's stock market opens a couple hours after New York closes. So what these people would do, and some of them were involved in the fund, and some of them were just people in the company, they would sell the Japanese fund the day that the market in the United States fell, and then the next day they would buy back the Japanese fund, anticipating, often rightly, that the Japanese market would follow suit and fall 1 or 2%. So you see what they're doing? They're gaming the system. Now, many mutual fund companies simply would not allow this to happen. They would say, if you sell it, you can't buy it back for 30 days. Or if you sell it and buy it back, we're going to charge you 1 or 2%. It's called a frequent transaction fee or something. I forget exactly the name of it, but frequent redemption fee. Because that's not what mutual funds are for. They're not trading vehicles. They're meant to be long-term investments. And for example, Alliance is a good company, folks. They're now called AB, Alliance Bernstein. In fact, we're going to see one of their funds in the next presentation. But there were 2 people in Alliance that were doing this. 2 people in the entire company, and the whole company was tarnished. The one that's probably the saddest is Strong Funds. This guy, Richard Strong? No. Yeah, Richard Strong. He started this company. And from scratch. I mean, this guy was a CEO, a captain of industry, somebody we should look up to. He was worth $600 million at the time that this was going on, and he netted about 80 grand, as I remember, $80,000 of ill-gotten gains, not illegal but not ethical. To you and me, $80,000 is a lot of money, folks. I mean, let's not mince words. But to somebody who's worth $600 million, and he was very contrite, and he said it very plainly. He said, look, I've ruined my life. I've let down all the people who respected me and who loved me, my family, my friends, my associates. For what? For nothing. For literally nothing. It was a classic case of Greek hubris. And if you don't know what I'm talking about, go over there to the literature department and ask them about Greek mythology and hubris. Why would you do these things? Because you begin to believe what everybody says about you, that you're invincible, that you can do no wrong. Yeah, so some of the Putnam, one of the oldest companies in the mutual fund industry, and they almost disappeared. Poor George Putnam was rolling in his grave. The vast majority of companies never engage in any of these shenanigans, folks. And it wasn't like you lost the money. You lost a lot of money if you were an investor in one of these funds. It's not like losing everything. The folks who invested in Enron or WorldCom and then weren't allowed to sell their shares in their 401k after they had been convinced to buy all Enron shares and lost $99,999.99 on their $100,000 account. Instead, you lost a penny on a $100,000 account. But if you have 1 million investors, stealing a penny from you, get the idea. Okay, that's our introduction to mutual funds. When we come back in our next presentation, we will take a look at fees. And you will learn more than you ever wanted to learn about mutual fund fees. But, as we said, you're going to be the expert for your family and friends, so you can't let them down. Go back over this, make sure you know what we discussed and understand what we discussed, and then we'll see you in our next presentation on mutual fund fees.